Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
So it's a great pleasure to be here. Thank you for having us. And Jamie, as always, it's great to talk to you. Jamie's been a friend, mentor, and guide and leader in the restructuring business for a long time, and he continues on with the new chapter of his life, which he can talk a little bit about. But let me start off, Jamie, with the world's an interesting place these days. There's a war going on. Private credit, large private credit firms are putting up gates. AI. So it's sort of an interesting time in the world. And I'm gonna walk through. You've been a leader in the business as an attorney, banker, now as sort of a financier. Amongst other things.
Can't keep a job.
Or, consistently curious. All good. Let me start by talking about your thoughts on private credit writ large. What do you see going on? It feels at some level when I speak to people at these firms that they view this as a media-generated firestorm. Thoughts?
Yeah, so the private credit asset class has been in one of explosive growth over the last, decade or so. It was almost, $0 asset class, and now it's, depending on how you count, call it $3 trillion-ish. So it had tremendous growth, and as happens in almost every development in financial markets, it goes one way or the other, or both ways, too far. And so you had this explosive growth. It was this kind of flavor of the month. It was mostly institutional, mostly cash flow lending. And then it started going into the retail world, and that was an additional kind of gusher of cash. And the great thing about these private credit funds raising money from retail investors is it's steady inflows until it's not. And so then, excuse me, turn that off. And you've had a couple of blow-ups in the private credit world, but some of the blow-ups were not private credit, but they were attributed to being private credit. And so now you've had a decent correction in at least the perception and the momentum of private credit, and leading that has been retail investors heading for exits. Again, it's not necessarily actual bad performance, it's fear of bad performance. There's been some bad performance, but at a high level and even at a mid-level, the actual performance has been pretty good. But in the world of reaping what you sow, the great thing about retail, as I said, retail investors, is it flows in pretty quick, but it can flow out pretty quick until you put up the gates, and putting up gates is not a free lunch. It's got its own repercussions. So you've had some of that going on. But if you drill down into the actual performance, as of this moment in time, even though there's been some issues, there really haven't been huge issues. I think there's a lot of speculation. There was some other Jamie guy who said something about cockroaches. Are there other things going on out there that we don't know about yet that have yet to be uncovered.
Yeah, and I'll touch, you were working on a couple of the cockroaches, First Brands and Tricolor, which interestingly enough, both of those were not private credit.
That was my point.
So, there was bank financing and syndicated loan market financing in a big way. There are several other names. I just spoke on a panel a couple weeks ago on fraud in the lending world, and just thoughts on that.
Yeah,
and how widespread potentially could that be based on what you've seen in the past?
Well, it's hard to predict how widespread fraud is because you don't know about it till it kind of blows up in your face. Conventional wisdom is you can't necessarily underwrite around fraud. That is, if someone's going to defraud you, they're going to defraud you. I think that's only partially true. There's some truth to it, but like where I am now at Hilco Global, we have an asset-based lending private credit fund, and we have a diligence business also that helps other asset-based lenders underwrite the loans. One of the things we do is on the front end of situations is look into how a company's operating, literally go to the plant, make sure there's really a plant there, because it's happened where people say there's a plant and it's not. And then you go in the plant and make sure the machinery and equipment's actually in there. And then you go in and make sure the machinery and equipment actually works. And you look at the receivables and make sure there's really those receivables. Now, that costs money to do all those things, and a lot of times people don't want to pay for that level of diligence, or they'll do a sampling or something like that. And that's when you start to be more exposed to the risk that you're getting defrauded. So it depends on how you want to go on your diligence, because even these ones that have blown up are still low single-digit percentages. And so if you do spend so much money on all of your diligence to prevent fraud, it might be that you can't make any money. So I'm sure there's more out there that we don't know about yet. I can't tell you where it is. But I do think there's more that lenders can do to protect themselves in both the underwriting, the structuring, the execution, and actually the monitoring of the loans on an ongoing basis.
I'd agree. In certainly both of those cases, some old-fashioned underwriting and portfolio management could have helped a lot, which is sometimes lacking. And I'm curious, by the way, I recently worked with a company where a small company, but they were looking to get capital from a couple of family offices, and it was very interesting that they used a lot of ChatGPT as a diligence tool in that. So there were questions that were coming in that were generated by AI. I'm just curious, in your new world, or sort of broadly from your experience, have you seen much of that?
Some, and I have to preface it by saying I'm a tech idiot, so I'm not necessarily the guy to be talking that much about it, but it's coming. And even I use a little bit of ChatGPT these days, in just a minimal amount. But yeah, the using it is where it is. My take is where it is right now. It's useful, but it's not a substitute or replacement for the usual work. It might help you save some time, but again, maybe I'm just too old-fashioned, but I don't think it's at the stage yet where you can rely on it to a massive extent.
And it was very helpful in predicting the check-in time at LaGuardia last night. Or this morning, actually. So, moving on, sort of.
I think that's why the other panel's not here yet.
Your firm, I think you have a private credit business. Your new firm, Hilco. But you guys, as I understand it, are moving into taking it into the ABL market, which is a little newer development. Can you talk a little bit about that?
Yeah, as I mentioned earlier, the vast majority of private credit is direct lending right now, and that's cash flow lending. And I don't know the exact percentages, but well north of 80%, could be 90%. And asset-based lending is a relatively small percentage, but a fast-growing percentage of the private credit market. And it's really, there are cash flow lenders who are doing some asset-based lending, but it is a different skill set, both to underwrite it, but in particularly to structure it and to monitor it, because you have borrowing bases and you have revolvers, and it's a more time-intensive and complex type of lending than the traditional cash flow lending. And so you need kind of a different front office and back office to be able to do it. But we're seeing it as very much a growth business for us, for companies that aren't able to access regular cash flow loans. They're not necessarily going into bankruptcy. They're not necessarily default. They're not even necessarily distressed. But we call them kind of story credits. The way I put it is, their direct lending's kind of down the middle of the fairway, and these things are a little bit on the side of the fairway. They're not in the sand trap. So they have enough asset value to be able to support the loan. And by the way we underwrite it is we assume, unfortunately, that it's going to go bad. We're going to have to enforce, and we're going to have to get par plus accrued after all costs of enforcing out of the value of the assets. We wish our borrowers well and hope that's not what happens, but that's the underwriting thesis. And so if it's a company with assets, I was going to say hard assets, but it's not just hard assets. It could be intellectual property. It could anything that's actually worth something. Then they can access the asset-based lending market where they might not have access to the cash flow lending market.
So it's a little bit of sort of rescue financing or development from what something beyond banks could typically do with as a development of the ABL market.
It's some of that, but I would say there's a lot of it that's relatively healthy or close to healthy companies. So it may not. A lot of it isn't rescue financing. It's not a distress play. But as I said, it's credits that can't access the cash flow lending market because their financials don't justify getting a cash flow loan.
Yep. All right, so switching topics a little bit, and I think you can bridge sort of a couple of worlds. Obviously, liability management has been a huge theme over the past few years, and now there's been some interesting moves around sort of lawyers that do that.
I didn't notice that, no.
So I don't know if you want to touch on that, but in terms of what is the equivalent of liability management in the private credit world, and what do you see happening there over the next few years, if it's true that after a very long bull market in private credit, there may be some loans that need help?
Well, I'd say two things. I may separate it out. One is liability management is a manifestation of the search to disintermediate the bankruptcy process. People would like to avoid the Chapter 11 people, companies, clients, because it's become a little bit expensive, people would say. A lot of people in this room, I don't begrudge people making money, but
a little bit expensive.
Some people have observed that. And so there's been a search to see if there's alternatives. Liability management's one of them. There's a bunch of others. There's assignments for benefit of creditors. There's Chapter 9s. There's just the old-fashioned out-of-court workouts. And you've seen even a development of companies using other countries, UK in particular, but Singapore and actually Denmark, a number of places where they're literally basically advertising their system as being a more efficient alternative to the Chapter 11 system. And just as you can access our Chapter 11 system pretty much by paying a retainer to a lawyer or opening a bank account, it may not be exactly that easy in a lot of other places, but it's not so hard. So you just have a search for kind of efficiency, you might call it, in the system, which I actually think is not unhealthy. And so you have that going on, what I'll call that writ large. Then in the private credit world, there's a few things going on there. One, it's not as amenable to liability management as the broadly syndicated loan market, mostly because, in the classic liability management, there's some group of creditors, call it 50.1%, set off against another group of creditors, 49.9%. Well, a lot of private credit is one lender, two lenders, three lenders, so it's much more typical to get in a room quietly, a room much smaller than this, and make a deal. And so it's if you only have one lender or two lenders, it's pretty hard to have 50.1% and 49.9%. If you have three, I suppose you could, but it's less likely. Now, in the world of convergence, there are some very large private credit deals out there that resemble the broadly syndicated loan market, and in the fullness of time we'll see, but those potentially are more subject to the liability management type of dynamic. But I would also say in the private credit world, there has not been a credit cycle in the private credit world yet. There's been a couple of recent blow-ups, but I don't call that a cycle. And the system is not really set up to handle a wave. And I'm not predicting a wave, but if and when that happens, that's the plumbing of just workout specialists and people in these firms to, if you have one or two loans that are bad, that's one thing. If you have 15, that's a lot of time sink and a lot of expertise you need, a lot of opportunity for people in this room, I think, to help out on an outsourced basis on those. But I think that that's sort of a tale to be told. I liken it a little bit, if you go all the way back to the financial crisis, when the CMBS market and the RMBS market, commercial mortgage-backed securities and residential mortgage-backed securities went bad. One of the biggest problems was there wasn't an ecosystem that knew how to handle that amount of distress in that asset class. And we literally were involved in a bunch of situations where we just couldn't get a phone call returned. It wasn't no or yes or maybe. It was just you couldn't communicate because they were overwhelmed. I'm not saying that's going to happen in the private credit world, but it's not really set up to handle a distress wave. So if and when that occurs, it'll be interesting to see the way it plays out in terms of the ecosystem.
Yeah, the special servicing firms in those cases,
yes,
were nowhere near. They could handle, a very minute percentage of defaults. But
well, and in fairness, it didn't make sense to staff up and have a whole bunch of workout people waiting for the wave and pay all those people. But when they get hit by the wave, they didn't have the people.
Yeah, there is a little bit more of an incidence of cash-paying loans getting converted to PIK, which might be sort of early signs of something.
Yeah, I'm glad that was the other point I was going to mention, and I forgot, so I'm glad you prompted me. But that you might call that a canary in the coal mine in the private credit business for spotting the way the market's going. And you have had a increasing incidence of PIK, what kind of I might call bad PIK, conversions going on. There's some percentage of private loans have a PIK option in there where a borrower can, without the lender's later consent, it's in the document at the front end, where they can convert from cash interest to PIK interest. And the percentage of ones that have done that, or sometimes doing it even though the documents don't permit it, but just doing it with an amendment, has gone up. I don't know, dramatically might be a little bit overstated, but I don't know what one click down from dramatically is, but whatever that word is it's a decent amount. And those are, if people want to do their watch lists, and this isn't all transparent, but all those guys you've picked, there's going to be some cohort of those that are these are really backdoor defaults.
So let me switch a little bit. I have two more questions in the 3 or so minutes we have left. One, you touched on the cost of Chapter 11s and different tools. I've seen some cases recently where there was a UK filing as opposed to a US filing in a couple of instances. ABC's assignment for the benefit of creditors, receiverships, Article 9 sales. Where do you see all that going?
I see increasing uses of that. We put in our bankruptcy code in 1978. It was a sea change to the previous system. We've amended it hundreds of times since then with our, whoever doesn't like something that happened in a bankruptcy case, they go to Congress and lobby for that not to be able to happen to them again. The thing I always say is there's not a debtor lobby in D.C. There's fisherman's lobby, and there's a landlord lobby, and there's a labor lobby, but there's nobody who goes to D.C. and says, hey, I got a company that one of these days might file for bankruptcy. I'd like to have a good bankruptcy code. And so you've sort of had what was a really good balancing of interests from the 78 code chipped away at with these hundreds of amendments over time. And in fairness, the system is set up to be an adversarial system, which it was eyes wide open when they did it, that there was going to be a cost to that, but that the cost would outweigh, the benefits would outweigh the costs. And I still think they do, but the costs have become, more extensive. And so people are, looking at alternatives. I will say, I serve on something called the National Bankruptcy Conference, and we suggest amendments to Congress. We've suggested for many years now putting in a Chapter 16, and in that Chapter 16, it's kind of like a UK scheme. It would basically allow a kind of like a pre-pack Chapter 11 to just adjust funded debt and not touch the trade debt or landlords or anything like that. It'd be a very kind of efficient process. Congress has done with that what they're very good at, which is nothing. One of these days we'll see if they do something with it. But I think we in the U.S. we need to stay competitive, and I think we're not as competitive as we were.
So let me conclude with one last question. So you've been in the business a long time, accomplished a lot. If you were starting out today in the business, what would your strategy be for leadership with modern restructurings? Just to bring it back to that, where would your career focus be?
That's a good question. I'd say try to be lucky, but I always say put yourself in a position to be lucky. And that's, nobody knows exactly where this world is going to go. But we've talked a lot about, say, private credit and the out-of-court things. I would say get as knowledgeable as you can about all those tools in the toolbox so you have massive substantive expertise. But to me, those are just table stakes. And then do things like come to these conferences, meet a lot of people, build your network, because you don't know when you're younger, where you're going to be able to go with that, and whoever you're networking with, where they're going to go. And so, cast your wings as wide as possible.
Thank you. That was great.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.